Good evening, ladies and gentlemen, or good morning, depending on what time you're watching this. Today we're going to be talking about, are the bears back in control, or are there signs that basically this is just someone taking profit and that really the bulls have been in control, they're staying in control, and we may be going higher. Again, all these things are going to be answered today and more. So without further ado, let's dive in. Just quickly recapping what happened. Now, if you were a bull in this market this week, basically you just got haircut after haircut after haircut. There was just lower lows, except on Friday where we did catch a bounce. Now the question and theme throughout this video is going to be, was this a dead cat bounce, or basically we going to rotate to the upside? Was this a massive A to B pattern on the way up or an A to B pattern on the way down? We're going to be all talking about that in the key levels of the video section, and everything will be timestamped down below. If you guys want to skip to any part of the video, feel free to skip to that. Again, we're going to give you our own thoughts at the end of the video. This will just basically be segmented into each section that you can find timestamp below. Again, that will let you pick and choose what you want to watch. So again, talking about where we're going next. So the market basically sold off. We cut the dead cat bounce, or possibly a bounce here that we have yet to determine. Same with the NASDAQ. We're below all the moving averages, and we are on this trend line that we'll be talking about more in the future. However, let's just quickly dive into the news catalyst to see what kind of drove of this week, or was this just a pure technical selling pressure? So looking at the news, Monday, nothing really holding. Expectations for inflation actually went down, which is shocking. And then we got core retail sales and exports going up along with regular retail sales, better than expected. So higher booming economy, more money transacting, which basically means, hey, Fed can keep tightening if they want to. So that may be bad news or good news for the market. Market took it as bad news per se. Building permits coming in better than expected. So again, a larger boom kind of playing into this hyperinflation narrative that we're maybe starting to see more and more of in the economy. And then we had FOMC minutes come out that basically recapping the too long didn't read version is more participants agreed with more rate hikes in the future, which is completely countervailing to what the market is pricing in. Some participants talked about a pause. However, a vast majority of them believe that they need to go higher and that more rate hikes would be appropriate and the labor market needs to cool down. And the initial jobless claims came in slightly at expectations. I would say the previous number got revised basically higher slightly, so a complete wash on the net initial jobless claims. If you take last week's and this week's numbers, it's a complete wash. The 4-week average actually came in slightly above expectations, however, got revised from the previous week. So again, it's just a wash on the jobs. So nothing really gave that boost to the market that we were maybe possibly looking at. And then net speculative positions, which is very peculiar. And I've been trying to explain this to myself, and maybe you guys can chime in down in the comment section below why we're getting basically more and more cutting on these. So you got the first, the second leg, and then they're really coming back. They're almost back to trying to go back to zero, which would traditionally indicate a new bull market where there's more people being bullish on the market, but the market at the same time is not necessarily doing what it's supposed to be doing. You're not really, you're selling as they're capitulating. So it's really more people selling that are bullish are either taking profit, they're being bullish, saying, hey, I don't want to deal with this anymore. And that may be for good reason, because S&P on standard returns between 7 to 14% year over year. So therefore, if you're 20% off the previous year's closing price, that's pretty much stretching those returns historically speaking. So maybe people are just being more cautious about it. I personally think you're heading down to the 200 SMA. That's just my 2 cents, because you failed to hold at 50. The 200 is the next logical step in there, but we'll get more in the technical piece of this video. But basically, looking at all this combined, it's looking not too real healthy on the market. And Fatal's going to give you the biggest winners and losers for this week, and then I'll be back for the key levels of the market.
This past week, markets have been bleeding non-stop. As you can see, the S&P 500 finished almost 2% down. When it comes to the most anticipated earnings for this past week, we got here that on Monday there really wasn't much of anything. Tuesday, we got Home Depot, which I really should cover. New Agilent Technology C, which fell a significant amount. Cardinal Health and H&R Block with a couple other ones. Wednesday was a massive one. We did cover this one on the live stream. We covered Target as well as Zim. And yeah, guys, Target got massively hit when it came to the boycotts. However, they still gained a massive amount when they reported their earnings. Thursday, we got Walmart and Applied Materials as well as Dole. And on Friday, we had John Deere and Estée Lauder. All in all, these were the anticipated earnings for this past week. Jumping now into the heat map, we can see that this is a bloodbath. Coming over here to the technology sector, everything here is very massively in the red. But you can see that overall, the worst performer was the company Keysight Technologies, losing a whopping 17%. And the best performer was, of course, Nvidia. They actually have earnings this upcoming week, and they gained almost 6%. So we'll see how they end up after their earnings actually come out. Looking now into the communications sector, everything here was in the red. In fact, the worst performer was none other than Warner Bros. Discovery, losing 6.71%, but also take a look at Meta, losing 6.1%. Best performer is actually the company Omnicom, literally not going anywhere. They gained 0 on the week, so that's pretty hilarious right there. Looking now into the consumer defensives, once again, massively in the red. Only a few ones were slightly in the positive, and you can see here that the worst performer was none other than the company Estée Lauder. They just had earnings, as I just showed everybody, and they lost 6.5%. Best performer, though, would be the company Bungie Limited, gaining 0.27%, as well as Kimberly-Clark gaining 0.22%, and Target barely gaining 0.12%. Looking now into the healthcare, once again, wow, there's only a handful of them that actually gained. Worst performer here, by the looks of it, would be the company CVS Health, losing a whopping 10.77%. We also covered this one on a video, guys. That's actually that video's gotten a lot of views, so you guys might want to check it out. And the best performer, it's actually really easy to find. It's the company Eli Lilly, gaining 3.44%. Taking a look now at the financial sector, we can see that this is also massively in the red, with only, well, a few greens here and there. Worst performer is the company Discover Financials, losing almost 10% at 9.87%. And the best performer is actually really easy to find, is the company Market Access Holdings, gaining almost 6%. Looking now into the consumer cyclicals, everything here is massively in the red. Wow, there's only 3 ones. There's only 3 of them that actually gained. That's ridiculous. All right, worst performer, it is none other than the company Tesla. Yeah, I was not expecting that. All right, they fell 11.2%. And the best performer, actually, guys, I'm just going to say all of them because there's only 3 of them. Actually, there's 4 of them too. We got Ulta gaining 2.05. We got Chipotle barely gaining at 0.14. And the best performers here would be none other than TJX Companies, getting 4.23. And the best performer, we got Ross Stores, getting 4.7%. In the industrials, once again, blood red. Only a few of them that are in the green and one that's barely in the green. Overall, worst performer, it is the company Deere & Company, losing 8.75%. And the best performer is the company Generac, gaining 5.38%. But also, we got this one down here. We got Quantum Services gaining 1.45, and again we got over here Emerson, yes, I believe, yeah, Emerson gaining, well, flat essentially, 0.05%. Real estate, oh boy, real estate, this has been screaming bloody murder. You can see here that, of course, guys, look at Realty Income. I bought $2,000 worth of Realty Income just this past week, around $57. It ended the week $56.90. Oh my lord. And also take a look at the CCI. They went sub 100 like just for a little bit there, and I'm looking at this and I'm just like, this is ridiculous, this is insane. I'm thinking about buying more CCI this upcoming week because, well, this is a massive drop. All in all, though, the worst performer, it is none other than Boston Properties, losing 7.08%. But also take a look at this one, Kimco Realty Corporation, losing 6.28%. And the best performer is none other than TLR, gaining only 0.84%. Remember when this one was sub 80? I'm sorry, not sub 80, sub 90. There you go, 121. So hopefully everybody bought when that one was deeply in the red. It has recovered very nicely. Looking now into the utilities, also a bloodbath. We got here the worst performer be the company AES. I believe this was because I think they also have like a thing with Hawaiian Electric, so I think that's why they fell 7.45%. And the best performer, it is none other than the company Pinnacle West Capital Corporation gaining 1.1%. When it comes to the energy sector, this is unprecedented, seeing that gas prices have risen a significant amount. We got over here the worst performer being none other than the company Valero, losing 3.94%, and the best performer, well, there's only two ones that gained here, and that would be, PXD gaining 0.47, and the best performer being EQT gaining 0.98%. And when it comes into the basic materials, we got over here a lot of red. Worst performer was none other than the company of ticker CE, losing 6.59%, and the best performer, there's only three of them that gained. So we got PPG gaining 2.12, we got STLD gaining 2.87, and we got Nucor gaining 1.09, and I believe, actually no, FMC lost. Yeah guys, best performer would be none other than STLD gaining 2.87%. You can see here, very, very massively red market overall. And what we're really going to look for is next week when it comes to Nvidia. This is going to be an important one, guys, because whatever they do, depending on how their stock reacts, all the chips will pretty much follow. So that's going to be an interesting one. Let's see if they're actually able to make that $11 billion in revenue. And of course, we will be live streaming on that day, because that is one of the most anticipated days that we've been waiting for, both Mike and I, for a while now. So with that said, that pretty much is it for this section. Take it away, Mike.
So guys, as always, we're basically going to go to the weekly view just to give us the ranges for the week. And this week's pretty much as simplistic as it gets for anyone that really doesn't do technical analysis. You snap a line to each of the peaks of the week. That's your established up and down zones that you basically got to break to be bullish or bearish. And to me, I'd be looking at the 50-day moving average as my rotation bit. If I'm above it, I'm playing bullish. If I'm below it, I'm playing bearish. Now, would I be necessarily playing bearish until we get back to it? No, I would like to see that rejection off of it, setting up that nice A to B pattern. So hypothetically, if this was an A to B pattern, let's say we go to the 50, about there, projecting down to 420, roughly filling this gap, which you guys know my opinion about gaps in the market, that, hey, this gap getting filled, come back, complete this A to B pattern, that'd be nice. And also we'd be going down to this 200 moving average, which by that time, again, you're not going to get there like a straight line down. It's going to take some time. It will probably move up, and around this gap would be a nice place to find a balance around that 420 point. On top of it, the psychological number that we're kind of beating our way, where we broke into a new bull market from this last basic bear market, as they're terming it. But we got a pretty wide range, and the bullish pivot slash bearish rejection pivot is pretty far away from where we are now. So if we get an exhaustion rally up here, I'd definitely be thinking that we get one more or two more green days up here. If it's even a dead cat bounce, I expect more buying pressure right here, because you can see that volume was ramping and now we need to de-ramp and then ramp again. That's how I would basically play it. So again, we have to see how it all plays out. And the 50 is my bullish indicator for the week. I'm going to make it as simple as I can. As Warren Buffett says, make it simple. So again, 330 we break, or sorry, 333 we break. Hey, more downside potential. You short it, you basically go short. That's your logic of be a lower weekly lower low, and also it'd be pretty weak for the market, especially if this was a true bottoming bounce. Again, above the 50-day moving average, you're gonna have to see what price that is. Currently it's 443.96. Again, it's gonna move every single day, so you guys gotta stay on top of that. And then 438.11 as the bullish break, where I'd be looking for upside testing along with that upper gap to get filled. And that gap is right over here where before we had the downgrade of the US debt, so by Finch. And then NASDAQ's going to be a similar story. Now, you guys know I mentioned this trend line. I said once we break the 50, which we did, and we were down here, I was talking, where he basically said if we're not going to get above the 50, I'd be looking for this long-term trend line support. We gap down below it, open below it, push back up and close. So now we have to see, do we close? Again, I'm going to give you the same spiel I gave you when we were at the 50. If this trend line breaks, S&P is going lower along with the NASDAQ. If it doesn't break, then, well, you know, you got the same story you had here. So we could see a green day followed by a red day on it, and then the break similar to how we saw the 50, where we closed below it, then closed above it, then just absolutely crapped ourselves afterwards. So again, keep that scenario in play. That trend line is going to be very important. I don't want to see a close below it. So if you close below that trend line, I'd be looking at that $354.71 area to completely break. And that would then lead to this low point of volume right here, which really the NASDAQ is just going to crap itself afterwards, because once you start breaking that 447, 450 level, there's not a lot of price action down here. And really, you would just keep sending to the 200 moving average, where you got maybe a price action around the 320 level. So this is going to be the make it or break it for the NASDAQ, especially with the SMA then curling back down, being more bearish skewed on the market as a whole. I still have my bearish thesis, but I'm not going to be willing to necessarily play the kangaroo. Now, if I get a dead cat bounce to 50% of this move, let's say right here, so 50% of the move would be around the 362.55 level. And if we just quickly jump back over to S&P, and the 50% rejection would fall basically right at 440.55, which is what the markets like to remove, or 70% would be around that 50-day moving average. But this is one of those plays I'm not 1000% sure on, because I don't necessarily trust it to bounce. NASDAQ traditionally bounces more like 63%, which would come up, or 61% correction, that would come to 365. So anything in that area, I may be looking to catch a small short play. But again, we got NVIDIA earnings this week, so that's going to pretty much take all those theses and yeet them out the window. We have to see what its earnings do, which is Wednesday of this week. So mark that on your calendar, guys. And basically for the NASDAQ and S&P, I'm going to just quickly recap the ranges. NASDAQ 370.47 bullish, 354.71 bearish, and basically 343 rotation down to our weekly breakdown, or breakout 448.11, and then the moving average for the S&P being my pivoting point there. Again, if we look at some of these charts like Apple, below the 50, trying to catch a bounce here, pretty weak. Microsoft, just weakness throughout. Google basing around here, trying to fill this gap. Meta, gap, crush down below the 50. Next target, probably the 200 weekly moving average. AMD, trying to catch a bounce, but again, it's going to really depend on the NVIDIA sympathy play, or it's absolutely going to crash down to these moving averages if NVIDIA misses. Netflix, below the 200 again, very bearish, probably coming back down to the 350s for a retest of the moving averages and filling a lot of these gaps. And then good old Amazon, same story. So all these tech companies showing weakness, they're breaking their 200 weeklies. It's just very bad. It's just normal. Oil, like we always talk on the channel, pushed up, found a base, rotating back up. So classic A to B to C pattern, let's say, projects oil to $96.51 a barrel, which would basically create hyperinflation. The Fed would have to basically start throwing 100 basis point hikes on this, because if you already got sticky inflation with this, I would not imagine what that would do at a $6 or $5 national average. So again, keep an eye on oil. Right now, oil is looking like it wants to rip everyone's face off. And speaking of ripping everyone's face off, let's take a look at the VIX, because the VIX was interesting this week. So I did say it was either going to base out or dump in this area, or we're going to start rushing up. And on Friday, we got a push up. Even though the markets were basically red, ended green, VIX actually ended slightly red. But however, this is indication that it's starting to create more fear in the market. You're starting to people buy insurance. Remember, we haven't been back at these levels since basically May. So markets ripped up. We formed a base on VIX, has a secondary spike, and usually that's the one before the big rip. So we got to keep an eye on VIX. If it starts getting above these moving averages, especially if it starts getting above this $20 level, which is like the traditional pivot point for VIX, more pain ahead. The dollar basically just keeps pounding up. Pound ahead, straight line up above the 200, bullish for the dollar, bearish for the market. And last but not least, let's just take a look at the short-term and long-term yields. 1 month just kind of staying flat in this area, because expectations aren't really solidified around what the Fed's going to do, so it's not really going up or down. Same with 3 months, 6 months. So short-term yields are yielding pretty low. 2-year is starting to get near these previous peaks up here, so we have to see how it plays out. And the 10-year is basically double topping around this area here, which will almost be a perfect double top. But if it keeps busting through this, or if it busts through the $4.329% area, And then we got more pain ahead because bonds are just going to completely devalue and basically be really good opportunities if you want risk-free return. And the banks are basically going to get slaughtered in the process. I did mention this on the discussion part, so just giving too long to read version, guys. Inverted head and shoulders pushed out. Now you're basically coming back to the 50. So this is pretty bearish for KRE. You even failed to get to the 200. So you could be going sideways or you could be dumping down here, setting up a massive, and I mean absolutely massive A to B pattern on the way down, which completes down here, which will put KRE at $20.88. Basically going back to, I'm going to say probably the bottom of '08. So again, mimetic things like that, where indicators are saying, hey, you're going back to painful times ahead. Well, there's no more painful time ahead than the yield curve inversion that just still hasn't gone uninverted. We haven't created a new top, but we're getting very close to the 2008 length. We only got about a month left, month and a half roughly. So I will keep you guys updated as always on that. And with that, guys, we're going to dive into the news for next week just to see what catalyst we have, if any. Monday, nothing real much. We got 3 and 6 month bill auction, so we're going to see if that. We got Fed members speaking again. This is the Jackson Hole Symposium this week, so famous August speech that caused the market go down. I don't think you're necessarily going to get that on the markets, but again, just another thing to watch out for. Building permits, again, housing didn't really move it much. I don't expect new home sales or building permits to move it on Wednesday. And then core will do good orders and initial jobless claims as always on Thursday. So nothing's really going to move it, but you do have the Fed balance sheet, so that may pop the market. I really don't know. We have Friday, the Jackson Hole Symposium, which really we're going to be looking at Powell speaking on Friday, which is reminiscent of his August speech. Are we going to get a more August speech, or are we going to get more of a dovish speech? That is the question that we're going to be talking today in the debate section of the video, guys. So thank you guys for watching. If you guys would not mind commenting down below what you thought, hitting a like, it really helps the YouTube algorithm, and possibly subscribing to the channel. It really helps us out. We're trying to grow the channel and cater to what you guys want. So throwing out in the comment section what you would like to see next. And without further ado, let's get into the discussion part. So, do you think Powell's going to come out on Friday with like a Jackson Hole style reminiscence of 22 where he announced the 75 basis points speech? Or do you think it's going to be more of the hippie trippy, oh, we're getting inflation under control, there's progress, we're going to pound our chest and tap ourselves on the back and say, hey, everything's hunky-dory?
I personally don't think so, because I mean, their minutes even said that a lot of them want to continue to raise interest rates, right?
Yep.
Yeah. And on top of that, we just had, inflation go up slightly. So that one's going to be fun. Now, I actually don't remember last year's Jackson Hole thing. I really, really don't.
So Jackson Hole was when he came out, and that's like the famous speech of 22 where that's where they basically said like higher for, because that was when everyone is expecting like, oh, the Fed's like nearing its end of the tightening, or yeah, which is ironic, right? It's a little ironic of like, where are we right now? And speaking of basically where we are now, the market still for December is pricing in a pause to the end of the year. They're not expecting a single rate hike more.
A pause till the end of the year,
at least.
At least. Wow, dude. I'm looking at that and I'm just like, well, we're going to get PCE in a few days, right? I believe it's next week. And then we're also going to... Oh, is it the week after? Okay. Actually, are you going to be here when PCE comes out?
What? No. Let's actually go back to the calendar. Sorry. Let's go to the calendar and let's find out, because let's see. Is it the week of the 28th? That's when PCE comes out. We get GDP.
Yes, right there. You're right there. When is that?
God darn it! I fly out that day.
Oh man, because I was really hoping that we could do one like here together. So that would have been a great one.
Yeah, but they still don't have expectations for that. Well, and GDP quarter over quarter 2.4%. I don't know where everyone's pulling that number out of there, but.
So all I'm seeing is, let's see, we got PCE coming up. Then we got, as you just showed right there, GDP. Then we also have jobs numbers for August in September, right?
Yeah.
This is, and I believe we're also going to get a CPI reading before the FOMC. So I personally think, going back to the whole Powell thing, I think he's going to go down the middle again. I think he's going to save the possibility of a rate hike for the FOMC meeting. Because he's been saying, right, he has been saying, we are going to be data-driven. That's his shtick throughout this whole entire time. So him knowing that we're going to get PCE, him knowing that we're going to get another jobs report and a possible CPI one as well, before the FOMC meeting, I don't think he's going to want to jump the gun. You get me?
And I do believe the Fed kind of has a little bit of insight from like their own analysis of where inflation is going. And if their own analysis basically saying, hey, there's a possibility of it upticking, I think he'll prime everyone in this speech. He won't like come out Jackson Hole swinging, but he'll tiptoe towards a more hawkish side.
When is this, by the way?
So that's Friday at 10 o'clock. So market's going to be open and trading for an hour and a half prior to him speaking.
Okay.
Which basically is going to go absolutely nowhere till 10:05.
Pretty much, right?
And then we'll get the Powell says, and then bung bung, spike up, spike down. But the traditional algo jump.
Right. Right. Yeah, that was gonna be fun. But I mean, what do you think the market's going to do then? Because there really isn't anything happening next week. Well, actually, PC is the following. There isn't anything happening next week. All that's left is just the earnings, right?
Yeah,
I think that's about it.
You got home sales, but it's not. I don't see home sales moving the market as much as a certain one stock that needs to like fall 35%.
Which, when they're having earnings, right?
Wednesday of this week.
Wednesday of this week, which is the company NVIDIA. Oh my god! And we're live streaming that.
Oh yeah, and the thing is,
what you're doing, you're live streaming. I don't care if you're in your car. I'm calling you on Discord, and you're at least getting in this.
It would be funny. This is just my own amusement. If it completes this head and shoulders right here, it carves out that right shoulder, and then on earnings. Back down. That'll be nice because
head and shoulders is a negative thing, right? It's a bearish thing.
Well, inverse is positive. It's the inverse, so it'd be positive it was inversed.
But I don't know.
Right now with Nvidia, like if I look at it, you broke down below the 50, got back above it, couldn't hold it, broke down below, got rejected. There's more bearish signs on the chart itself versus like bullish signs, and again. Is it a buy the rumor, sell the news type of event where they were rumored to have $11 billion? And let's say you get the $11 billion in revenue.
Dude, you have been on that $11 billion.
I'm going to be on that point till Wednesday. It's like your thing with AMD. So it's like when they said that number, it literally... Here's the sad part about it. People have the memory of a fly. Not trying to insult anyone, but literally majority of people don't remember.
Short attention span.
Yeah, well, I would say memory at this point with NVIDIA. They've done this before. They literally had an FCC investigation of them lying on their earnings to manipulate the stock to then have insiders sell to have it crash afterwards.
I don't know about that. I never heard about that. But
what do you think caused this?
Well, a lot of stuff, right? A lot of stuff.
This is when they got the investigation because they promised on this earnings here some insane number, and then after these earnings, doink.
Yeah, I mean, they did what, $7 billion in revenue last quarter.
Yep.
And now they're expecting $11 billion. And I love it too because last quarter when we covered their earnings,
their year over year was negative.
You said before we did that, because I looked at the actual earnings report before we actually got to it, you were thinking, no, everything is looking great. And I showed you the earnings and I'm showing you it's a negative year over year value. And then you're like, wait a minute, what?
It doesn't make sense.
You were taking it back, and then you're like, this thing is up 30% in the past 5 minutes for a negative year-over-year value. What? All because they said AI like 87 times or something like that.
185.
I would love to see how many times. Huh?
185.
Well, was it that much? I don't really remember if it was that much.
They literally, like every sentence they could cram AI into, they literally were like, AI has boosted AI earnings to generate more AI. It's like...
Yeah, it's just absolutely crazy. But I mean, here's the thing, right? We have been seeing just topsy-turvy things when it comes to earnings. I mean, we've been seeing companies beat on everything, even bringing up guidance. Like, for example, Walmart, they just had earnings, I believe, on like Thursday, and I covered it in a video. Everything was in the positive. Everything was in the green. Guess what? They fell 2.5%. They fell like almost 3% after earnings. And you're just like, what? They raised full year guidance. They beat on earnings. They did all that stuff, and then they still fell. They still fell. All because their comparable store sales was slowing down. Granted, that is a big, big thing. But, you expect that to slow down with the economy the way that it is. So,
but it's also like, but then you get companies that like miss, and it's like to the moon.
And then they rise like 3%. Like you had Target get completely nuked because of the boycotts. I mean, we covered this. And what did they do? 3% up. Right?
Yeah, they're struggling. Like, they're struggling to get above that 50.
Sure. But I'm saying like on the daily, they went up like 3%. Yeah. That's my point. So you're just like, this doesn't make any sense. It really, really doesn't. And all eyes is going to be on NVIDIA.
Yeah. And if you look at the market, it's just like, it literally was like, the question that I have for everyone, do you think this was a dead cat bounce? Or do you think that it's going to be the sign of the reversal? Because you had massive selling on the market. Like there was, let's see,
around
1,
2%.
2, 3, 4, 5, 6, 7, 8, 9 straight days of just lower lows. And
on the week, the S&P 500 fell almost 2%.
And this is where I kind of indicated on like the key levels part. The 3 candles is very similar to here. 1, 2, 3, consolidation. Mm-hmm. This you can kind of consider like one candle. Let's say 1, 2, 3 in consolidation. 1, 2, 3. Like usually you have those like 1, 2, 3 candles on the market on the week, and then you go lower. But again, on the S&P, you have the moving average down here. So if we see continuation, if we see finally NVIDIA do what it was meant to do and crash 30%, this would be great.
I wouldn't even say that do what it was meant to do. It shouldn't have risen 30%.
Yep.
Right? If it didn't rise 30% overnight, I would be like, okay, well, I mean, it's still slightly overvalued, but it's not that bad. 30% overnight. I'm looking at this, I'm just like, what? Dude, if I had NVIDIA, if I had NVIDIA shares, like 100 shares, I would be selling that nonstop. As soon as that thing rose that morning, as soon as 9:30 hit, boom, instant sell.
You would sell it on open.
I don't care.
You wouldn't deal with this craziness.
Nope. Not after a 30% rise. No
How
way
much
in hell.
would it be? 27%. Second peak of 45, and then let's see, last peak of 59.
Not to mention that NVIDIA also doesn't pay out a big dividend to begin with. It's strictly just for selling. Even though it does pay out the dividend, it's just mainly for selling.
It's like Intel.
I wouldn't even say Intel. No, it's more like an Apple, right?
Okay.
Where they pay out the dividend, but it's not that big. Regardless, I would have just sold.
Speaking of Apple, Apple actually came back down to like this consolidation point here. So I could see Apple bouncing here, but it's like, again, now would you trade this? In my opinion, no, because you're in the kangaroo. You're in this kangaroo of the moving averages.
Well, from a discounted free cash flow approach, I mean, we did it. Apple's a good buy at around like this price.
Yeah, it's starting like that's where we said, and like you could accumulate here, and then you know if you want to sell calls to just cover yourself from any further downside, that's an option. But like if you look at like let's say Google, right? So Google's basing around here. It cracks, it'll take the market down with it, along with Amazon's cracking. Amazon's below the 200 weekly. It's like rejected, and rejected. So it's like
gap,
reject. That's the worst part.
Gap, fill and then reject. How about that?
You haven't filled the gap yet. You still got a little.
No, they did. Are you kidding me? Look at that gap fill right there.
There to there. You still got this little section right here.
Oh no, I was looking at the other gap.
Well, this one.
I was looking at that big gap.
And no.
Fill gap. No. The gap to the right of that, my dude. Come on.
This one.
Yeah, that one right there. Yeah.
No, because it's right
that
here.
Gap filled.
No.
Okay, well,
the last.
Apparently, I don't know how to tell gaps from a technical perspective.
Here, look at this candle. It's this candle right here. That's the last.
Okay, well, clearly I don't know.
Clearly I don't know. But it's like bounce up, fill gap, keep going. Bounce up, fill gap, almost probably keep going. Yeah. So it's like Now,
So,
do you believe in this 50 bounce? Maybe,
I don't know.
maybe not.
I don't know.
So a company dancing around this key level right here like this, not showing strength. Microsoft, your baby, just nuked everybody from 360 all the way to 316. It's like,
wow. Dude,
buy the dip, lose money. Buy the dip, lose money. Buy the dip, lose money. Buy the dip, lose money.
So here's my question now. Obviously, markets are coming down, right? Is Mike Burry correct? Because for all of those of you who don't know, and by the way, we did cover this on the live stream. Michael Burry shorted the Nasdaq. He bought puts. He bought puts worth like what, $1.6 billion. Again, kind of misleading headline.
So for all those,
but still,
for all those that don't trade options, there's a thing called nominal value. That is the put contract. If it's expressed, what is that value in shares? So
times 100 and then times the security price.
Yeah. So for example, if he's buying
1.6 billion,
if you take 1.6 billion, right? So if we basically, let me get this calculator over here. So let's see, 1.6 billion. Let's see if I can actually get this ding right. Okay.
That's not
thousands.
Is that 1.6?
Yes.
Is that 1.6 billion? No. Oh yeah, it is. Yeah. 100 million and then
thousands, millions, billions.
100 millions, billions.
So that's trillions. Now it's this would be a million. That's
1.6 billion, buddy. Yeah, that's 1.6 billion. Yeah.
So if we divide this by 100 shares, which is where the contract values would be, you're only looking at
16 million.
16 million.
And obviously we don't know, and also we don't know what the securities were worth when he bought those puts to begin with. So,
and I kind of know his strike price on SPY. So let's say, because it was a 50-50 split, so you're looking at 8 million divided by 720,000, which is what the strike price was. So he's basically, his position size is only maybe close to 100 grand.
Wow.
But it's expressed because it's the way that FCC filings work. He's taking 1% of his, I will say 1%, 2%, which is standard for options traders, right? Like that's the standard risk portfolio. And he's shorting only 1% with the nominal value of that. Now, his upside is if he gets the proverbial market crash, he could easily turn that into 100 billion and basically just make stupid amount of money. But he's risking very little. He's not like back in 08 where he literally took and basically put his hedge fund's entire portfolio as collateral. And that was a risky bet because it was very, very leveraged. However, he made out with like a bandit doing 400% on the hedge fund's earnings the performance at the end of the year. So everyone's saying like, oh, his bet against the stock is a sure loss. I beg to differ for the sole reason that this yield curve inversion is still inverted.
Dude.
No.
Inverted is an understatement at this point. All right? It was inverted last year. Now it's making loop-de-loops and going higher.
What's making loop-de-loops is this. The 10-year double topping basically here. Lord. Pulling back, and here's the thing: this candle, if you look at it from a pure technical standpoint, this means continuation. So, like, you got the selling candle here, where you're piercing the highs, which you're expecting to have a pullback. Had the pullback, bought the entire pullback back up. Now the question is, on Monday, if we start seeing the 10-year knocking on the 4.3, 4.35, I'm gonna stand by what I said of we're gonna skip recession, we're heading towards depression, because these things don't, the 10-year doesn't just instantaneously decide to rip your face off from 3.2 to 4.2, 1% in 4 months.
Right.
That's just long-term yields don't move. Period.
When was that peak? When was that peak prior to, like, when was it? Like last year?
Last year, October.
Almost to the year. To the year. Okay.
Yeah. This is when Powell opened his mouth. This is what the result was.
Wow. Oh my God.
So okay.
And then
take
hang on.
And do it again.
And then let's add insult to injury. We only have less than 15. What do we have? Like 12 days 13 days until student loans starts to get to turn back on again.
I love how the media, like we mentioned before, the media is now starting to talk about how student loans may be impacting the economy and companies' profits.
Maybe nothing, it will. I mean, the average student loans is $503 per month. That's on a nationwide scale.
And there's
basic
some
Google search.
Yeah, I think the Kansas City Fed did an analysis, or one big major bank. I don't remember who did it.
I remember you talk about this.
Yeah, showing like 15 billion in revenue per quarter being sucked out of the U.S. 15 billion per month, market, 45 billion per quarter being sucked out of the U.S. economy. I'm like, let me just go over and just tell Apple, Microsoft, Google, and Amazon that you're gonna lose 10% of your revenue. Like
the bottom line, or the top line. Sorry,
yeah,
the top line.
It's like you're gonna look at me askance, and basically like. At my work, like they recently started talking about like the market report continues to show a weakening consumer. I'm like, wow, we pay people to do this. I could have told you this. I told you this 6 months ago. Crap, pay me that with their salary and fire them. So that way, it's like anyone can look at the 10-year. That should look at the yield curve. Basically, if you see this, that means weakening consumer because Federal Reserve needs to basically pound this back into oblivion.
Yep.
And the only way they know how to pound this back into oblivion is to take this yield and basically say, okay, add plus 0.25, go up here, add plus 0.25, go up here, and which would top out if we go back to where we're knocking on the door of 08, which 08's tops was 5.2.
Oh my God.
.com was 6, but then again, like, the devaluation of money and stuff. But
dude,
it's like
this is going to get ugly quick. I mean, we even had one of our friends actually tell us how does he buy bonds? How does he buy treasury bonds? Because they're so stupidly cheap right now with such a high yield that it's just like, why not do it, right?
Well, so let's just look at this 3 month, right? You're tying your money up for 5.4%. So you're basically going to get
for 3 months.
Damn calculator. So let's just do the math. If the calculator likes me today. So 5.4, you're going to basically lose 0.1% because how the spreads work, right?
Sure.
Divide that by 12 months. You're getting 0.44% per month times 3. You're getting 1.3% on your money. So if you put in, let's say, 10 grand times 0.013, you're making $130 on 10 grand.
In 3 months.
In 3 months.
In 3 months. That's an insane yield.
For zero risk.
For zero risk.
Remember, you're not going to get Nvidia returns, but Nvidia could also take 35% of your money.
Yep.
Bonds can only give you you're basically giving up yield per se, which you're not really giving it up. You're giving up. To me, guaranteed return.
You're not giving up anything. You're not giving up anything because if you go to maturity, you get back your money and then you get that yield back. So you're really losing nothing.
You're only giving the opportunity to make more if you're buying stocks. However, stocks have the negative effect too that you can lose money. So you're basically trading off, comparing the two. I'm saying in the comparison, you're trading off high return. But your risk portfolio is uncomparable.
Zero.
It's uncomparable because zero risk for a guaranteed percentage. You would have to. It's like, go ask yourself. Okay, so I can get 5% for zero risk, or standard S&P returns between 9 to 14%, and we're on the upper edge.
7 to 10%.
And the max it's ever returned is 20 on a closing year basis.
7 to 10% per year on average.
On average,
with the risk that it could go down.
Yeah.
Right.
But let's play the hypothetical game, right? So beginning of 23 to max, you were at 21%. You're right now at 16%. So the odds are not necessarily in your favor to only get, if we go what you said, 14% on the yearly basis close?
7 to 10.
So 7% would bring you so it would actually bring you back on a yearly closing average back to the moving averages.
Yeah.
I don't mean to be the party pooper in the whole sense, but that's a compelling case for history tends to repeat itself. Here's your target for the end of year. And if you're buying here, why, like, you've maximized the returns on the market, right? So, or the argument can be made. Now, I know there's going to be people that are saying, oh, you don't know what you're talking about because I've made so much money on the S&P. S&P only goes up, new bull market. Well, let me put some holes in that argument. XLF looks like it basically just wants to come crash back down. It's now below, or was below, I should say. I'm going to correct myself. The 200 moving average, it cracked right through it, came back above it because people are buying it. But right now, you're in the kangaroo. Where do you think banks are going to go? You think banks are going to be bullish? Banks haven't been bullish since the beginning. We have KRE touching the 50. Again, where is the health in your banking sector that services all the other sectors? Every time we show this, it's like, okay, let's see, inverted yield curve, and you're coming up on basically 1 month anniversary nearly of the 2008 inversion length. So
yeah, it's looking it's looking bad.
Yellow is where the recession gets bad because that's the Great Recession. So basically, once you cross this yellow line, it's going to be hold my beer, Great Recession. Orange is when I think it's going to break loose, and then red is the economists will be right. We're not in a recession. They just don't realize that they're in a depression.
Right.
And God help you, and I mean God help us all, if we're in March or May of next year and we still haven't gotten the effects, because then you're gonna redefine what depression means.
Funny, because I'm calling this out right now. I'm specifically saying we are going to see the outcome of the student loan repayment system in Q2 of 24.
The full consequences.
Right. The consequences of that we're going to see in Q2 of 24. So where does that land you? Pretty much March, April of 24. So it's going to be bad. It's going to be bad. But even with all of this, the market still fell around 2% this week. And where does that put us when it comes to the fear and greed, good sir?
Fear and greed knocking on the door of fear.
We are knocking at the door of fear. It's looking good right now. Let's hope that this thing ticks up a little bit. Maybe go to the door of greed, and then starting next week it comes back down to maybe fear.
So basically what you're hoping, or are you hoping we turn into greed?
We turn into slightly greed.
We hypothetically come back to the 50, reject off the 50, then crank all the way back down to 0.
I wouldn't say crank down to 0, but I would say get into like the fear / knocking on the door of extreme fear, right? I think that would be a healthy thing to do. Go up and then come back down.
And just to close this whole discussion out, I got one thing. Where do you think the net speculative positions are at?
Probably a lot lower. Did they increase it? Increase it?
They're capitulating out.
Ooh.
So this is the interesting thing, right? So everyone was saying, and this is the question I have for every bull out there. This was a bear-fueled rally. Your bear fuel is gone. Gone, capitulated. They're coming out basically saying, hey, we'll take a small loss. And you still have selling. So who's selling? All the profit takers, all the bulls. No one is willing to buy this dip. You had the toe dippers here. But
the toe dippers.
No, that's what they are. They're dipping their toe just to see if how it is. If you for example, I'll use the example. On here. You dipped your toe, it came up here, you maybe took profit, and then you got blown out again. So they're taking small losses, but their upside is pretty good because toe dip here, okay, big win, right? So they're trying to buy a little bit of the dip, but if we go to the 1 hour, it's just nope. And to me, this looks like a dead cat bounce.
Consolidation right there too. So
yeah, it looks like a dead cat bounce. Yeah, so if we just do simple A to B pattern, right? Let's say we get a little more of a bounce. Let's say there, 424 coming back all the way, trying to fill this bottom gap here. I'm like, everyone on the channel knows my opinion about these godforsaken gaps and how one day we're gonna basically go to fill them. Are we gonna start coming down now? Remember, we got gaps down here at the 400s. So hey, everyone said we can't break the 50. You didn't even. I said I would be shocked if we basically just send right through the 50 on the S&P. Well, I'm gonna eat those words right now because we just said hello 50, goodbye 50.
Bye 50. Yep.
And that's not strength in the market. That's not a bull market. Bull markets, if you're in a true bull market, true definition bull market, It is you bounce there with conviction, and then maybe you consolidate afterwards, right? But you don't allow 2 closing candles below. You're a nice, let's see, what percentage for way? You're 1.6% on the S&P. The NASDAQ, even worse. You actually came down to the line that I said, hey, you break the 50, this is where we're going to. Oh, look, like it's freaking science, right? No, it's just common damn sense at this point.
Well, for technical analysis, yes.
But the thing is like 3% away from the 50. Okay, so you got to do 1.5%, 3% doable if you got a catalyst. And the only catalyst you really got is Jerome Powell. And do you think he's going to put it... I hate you. I hate you.
I know,
but
I know you do.
I hope Nvidia comes out and says we made $6 billion in revenue and we're
anything under 11 billion would do it. I think anything under 11 billion, and I honestly think that would essentially crush the whole AI concept.
Because, it needs to. The euphoria needs to. It's like .com. It needs to repeat. Here's the thing. It's like
.com. It's .com. It's the blockchain. It's the EV craze. It's all of that.
Which I'm not saying AI is not a good thing, but you can, like you always say, you can overpay for growth.
You can 100% overpay for growth.
But the closing comment that I want to make, and I want the chat to, or you guys are watching, throw it down in the comments section, like as well. It always helps us out. Is do you believe that Nvidia, we're gonna ask I'm gonna give you the bullish scenario question and the bear scenario. If they come out with $11 billion revenue, do they, one, go up? And if so, how much? Or is it buy the rumor, sell a news event? That's question number 1. Question number 2 for the bears out there. If Nvidia comes out with like $8 or $9 billion in revenue, 1, does everyone wave it off? Or 2, does it beat Mark Zuckerberg's epic sell-off of 25%, losing $150 billion of market cap overnight? Is it going to have a hold my beer moment to Facebook?
That's gonna be an interesting one. That's why I can't wait until Wednesday. It's gonna be insane. But anyways, guys, I think that will pretty much do it for this video. If you like, comment, subscribe. It really does help here on YouTube as well as Rumble. So with that said, we'll see you all next week. And again, the live stream, what time, Mike? 6:30 or 7 p.m. on Wednesday?
7 for Nvidia, because that way we'll get all the press conference out. We'll get all the craziness.
So 7 p.m. on Wednesday, 7 p.m. Eastern Standard Time on Wednesday. Be here. This is going to be an insane one. Let's see, is AI really going to get destroyed after this? Or are we going to get another 30% of hype? So with that said, peace out, and we will see you all next time.